Welcome to Trader TV. I'm Dan Barnes. In 2020, buy-side equity traders are facing very challenging markets. Tony Nash, Managing Director for Electronic Trading at Stifel Europe, is here to discuss how trading risks and costs are being overcome. Tony, welcome to Trader TV.
Thank you, Dan. Good to be here.
So tell us, what were the most popular trading algorithms during the recent market volatility?
So we saw a change in behavior from clients who were moving away from passive-based VWAP, TWAP strategies toward more strategic-based, almost synthetic DMA strategies, where the focus was on finding liquidity at the right price. We also saw a move towards using dark access to getting blocks done. And of course, we have access to 50 venues through Sonic Dark. So that became, hands down, our most popular algorithm, because we felt some customers were leaving a block of liquidity in the darks while they were working in the lids. Okay, and if it hit their limit, they were happy to get done.
If stock price action is actually difficult to predict, what sort of strategies do you think clients should be using?
I think one of the hardest choices for a trader when you have stocks trading linearly down, for example, and you've got a sell order, is waiting for the bounce. And if the bounce doesn't come, you run the risk, the longer you wait, for being sort of further away from your benchmark, and potentially you could have a PM raising their hand saying, listen, I gave you a sell order in the morning. You're 4% off the close. You didn't get me finished or partially completed. So that's the risk. And what we did see for those stocks, our clients did turn towards more passive-based strategies like VWAP, for example, but with an embedded price. So the idea there is that it's almost like a trader hedge, where they would just start trading using VWAP. At least they're getting some done. If it bounces, fine, the wood price would take care of some of that. Or in fact, there'd be an overlay of other strategies as well, which is the other thing that we saw, where we offer over 50 different algorithms from 5 providers. So clients had a wide range of choice, and they would often overlay 3 or 4 strategies for the same order.
How did the volatility affect the actual trading objectives that they were trying to achieve through that execution?
We immediately saw a shift towards a change of intraday behavior from clients, focusing on implementation shortfall as the benchmark. And we found there was much more a focus on what was the price when they started the order and how are we doing versus that. Also, we found that there's an increased need for us to provide in-flight TCA to clients. So we created products where we could, at any point during the day, have a good grasp of where clients are executing, which venues they're executing in, and then advise them on the fly accordingly.
So what impact did that have on execution approaches for different funds?
We saw customers moving away from a single strategy used against an order to using multiple strategies and overlaying them against orders. So typically, customers would put up maybe half the order in the darks at a limit that they want. Then secondly, they might have a strategic, almost like a synthetic DMA order, where it would pounce on a certain price in the lids were available. And then they'd have a liquidity seeking strategy that would maybe post some of their order shapes and never cross the spread.
And then how does that differ from trading in less volatile markets?
So we found that in less volatile markets, there was a focus on counterparty risk. There was a focus on more compliant-based issues. So TCA was a requirement that was focused on less for trading, but more for compliance issues and post-trade monitoring. We also found much more use of passive strategies like VWAPs, but also sort of like in-line with volumes and also close strategies. But we would advise them based on the in-flight TCA that we were providing. And it really hinges on this low-touch plus sort of model that we have, where we give what we feel are the best of breed algorithms to clients, but also you've got 5 electronic sales traders that are experienced that can help guide clients away from or towards different strategies.
Tony, how have the costs of trading changed over the period of 2020?
In a normal environment, you'd find that a customer is happy being 10 basis points away from a rival price. Where volatility is low, obviously the standard deviation is low, and spreads are quite thin. Now, when spreads double or treble and there's a drop in liquidity, you do find that customers' expectations in terms of value changes too. So they might be happy with 25 basis points away from a rival price. Why? Because volatility has quadrupled or gone up 5 times, spreads have gone up 3 times, and liquidity is far more patchy. If you have a look at a 15-minute mean reversion, i.e. when you've stopped trading and the stock bounces back, in a highly volatile environment, that has less meaning than it does in low volatility. In other words, when it bounces back quite aggressively in a low volatile environment, you've probably been a bit aggressive on your participation ratio. If it's low, however, then you have got capacity to increase. We found that clients have been very engaged with changing their behavior according to these numbers, and they've shifted their mindset away from what value is perceived in volatile markets and not volatile markets.
Tony, that's been excellent. Thank you.
Thanks very much, Dan.
I'd like to thank Tony for his insights and, of course, you for watching. To catch up on our other shows, go to tradertv.net and etftv.net.